Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. He tells us new highs are being reached because unemployment numbers are not as bad as many expected. InsideTrackTrading.com President Eric Hadik gives us a look at the cycles that give an indication of what's going to happen to the stock markets, gold, the US dollar, and crude. He also explains diseases follow a particular cycle. Market historian Bob Hoye gives us some perspective on what's currently happening and answers listener questions on whether we're heading into stagflation and whether the US dollar is looking at a collapse. Plus, at the end of the show, we'll have company showcase updates from American Manganese President Larry Reaugh, Cypress Development's Don Mosher, and Aben Resources CEO Jim Pettit. We'll talk to Ross Clark right after this.
Cypress Development Corp is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYD-VF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can also find him on Twitter at ChartsByRoss. Welcome back to the show, Ross.
Good to be with you, Jim.
Ross, encouraging unemployment numbers in both Canada and the U.S., and when I say encouraging, who ever thought 13% unemployment would be a good number?
It's always about the perception of what you expect versus what arrives, and in this case, 13 is a lot better than 19.5 that they were talking about. Some numbers were actually well above that. The U.S., you've got employment, the number of employed is up 2.5 instead of down 7.5. So, and in Canada, new jobs, but where are they and how are they doing the measurements? The bottom line, though, is that the markets have had just a huge amount of liquidity pushed at them through various, doesn't matter where you go around the world, the central banks, Federal Reserve, etc., have been pushing literally trillions of dollars, and the money always finds a home. Sometimes it's in commodities, sometimes in the bond market, and in this case, the equity markets have clearly been just on a rampant move. The action at the tail end of the week is pushing us to new highs in some of the indices. I was looking at I've got a portfolio of about 1,600 items that I run through a scan, and 4% of those are sitting right now at all-time highs. I mean, not just taking out, the recent move, but or even earlier this year. These are all-time highs, and these some big names. You've got Apple, you've got Home Depot in there. So the money has been shifting, and the Fed has been sitting there buying up debt, the high-yield bonds, the JNK and HYG. They've literally been in there participating in that to support it. And we always have to remember that the bond market is 10 times the size of the equity market. So if you can keep the bond market on the corporate side healthy, that's a good thing. So with all of this buoyancy that we're seeing, the risk-off items that are usually out there as a protection for people, the government bonds, the gold market, they've been taking it on the nose the latter part of the week. This actually for gold fits just beautifully with the model that we're working with. That combined low that we had in April, May, as far as gold and oil was concerned, had a good recovery rally. outpaced in a big way by silver, which managed to put on a new high for the year this week. But the probability was that we would, after that bounce, have a good solid pullback. And we're looking at the probably gold giving back a good 38% of the run-up of the last year or so. So we've got two targets, short-term support probably around the 1660 range, but the best support, and we're hoping to see that sometime in the next month or two, more in the 1560-ish range. So that would be we would usually say mortgage the house and go in and buy, but in this case it's probably go do a reverse mortgage and go buy what you can.
Oil, is it continuing to be strong?
Yes. Oil, we sent out a report on that one this week. The upper targets, now if we look historically, since way back to 1980, the $37 to $41 range has been both a cap for many years and also a support that it briefly overlapped back in 2009 and 2016. So the rally from this capitulation low that we had a month ago, we're looking for that to find resistance as we get around this $40 level, and we're basically within a spitting distance of that right now. The other thing is that the oil ETFs, the XLE in the U.S. and the XEG in Canada, when we look back at the hard breaks that we've had historically in those indices, where they've been down 40% or more, the first bounce off the low generally recovers each time. It recovered 38% and then had difficulty for the next month or two. So for the XLE, as of the end of the week, it has reached what we believe will be an upper resistance level around 44.5. We've also got some counts in the sequential model that we use that have weekly sequential nines at this point. So the probability of a good pullback in the oils would not be out of line at all. I think if anybody has been in there for the run, and we've had 70% moves off the bottom. These have been really nice moves in the broad oil indices, let alone what some of the really devastated ones have bounced back. It's probably a good time to lock in some profits on those. And we've got some work done. Clearly, there's going to be some nice support areas that we can look for at some point, probably in the next 4 to 8 weeks.
Does the recovery in oil account for the Canadian dollar gaining about 5 cents?
Oh, yes. We've been looking at the dollar having that resistance at 72 cents, and it was having difficulty keeping up with what was going on, not only in the oil market, but just also in the CRB index itself, the Commodity Research Bureau index. And as it closed through 72 cents, that really became the catalyst for the upside move. And so here we are at 74.5 to finish off the week. If anything, and this is now, as I say, with the move in oil, I think that if we put it in an interim high in oil, and that the Canadian dollar at that point would be ripe for another setback. There's nothing to say that we can't go back down to the lows of the year again. I don't see that Canada is in a good position, so when we get some sell signals, we'll look to be fairly aggressive once again.
Ross, thank you so much for being on This Week in Money.
Always a pleasure to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can also find him on Twitter at ChartsByRoss. Coming up, Eric Hadik, next on This Week in Money.
Always consult your investment professional before making any investment decision.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Eric Hadik, CEO and President at InsideTrackTrading.com. Welcome back to This Week in Money, Eric.
Oh, thanks for having me back, Jim.
Eric, before we get into our questions, can you tell us a little bit about InsideTrackTrading.com?
Well, Inside Track and we offer several different publications. I have been involved in the markets since the 1980s, and I take a technical and cyclical approach to the markets, but really probably the most important thing to me is synergy, that any and all of the indicators that I watch and cycles that I watch, I need to see a pretty strong synergy of coinciding and correlating indicators before I'll really give them much credence. But so we provide a lot of different analysis on financial markets, commodity markets, metals, stock indexes, and also do some analysis on broader events that range everything from geophysical cycles to even what's gotten a lot of publicity lately is disease cycles that I wrote about 5-6 years ago, and we're pointing to 2019, 2020 as the next phase. There's a whole litany of different natural events and cultural events that cycles seem to really have a important role in assessing them and analyzing them, and so that's also included in some of our publications.
Well, I guess because we've had the entire planet locked down for a few months now, where are we in the disease cycle?
Well, the ones that here again, synergy was such an important thing. I had done it started back in 2006. I had done a series of articles on a very consistent 10-year cycle that seemed to time disease/virus/influenza outbreaks, and it had been pretty consistent since the late 1800s, and 1889 there was a big one. Each of the decades after that, then 1918 through 1920 with the Spanish flu, and just continuing just about every decade. Right towards the end of the decade, you saw these outbreaks, and so in 2006, I was detailing this and saying to watch 2009, 2010 for the next major outbreak, and along came swine flu in 2009 and 2010, and just corroborated and validated that cycle again. So a couple years later, when Ebola came out, I had a lot of subscribers saying, hey, you talked about those disease cycles. How does Ebola fit into that? And I did an update on this analysis. I said, Ebola really doesn't, the cycles that I've seen, and this was in 2014, I said, this doesn't really fit, that I continue to focus now on right around 2019 as being the next big outbreak. But I went on to detail where it wasn't just this 10-year cycle. There was some longer-term 100-year cycles and a combination of a lot of cycles. And so periodically I'd just kind of revisit that and talk about the time frame surrounding 2019. So when we hit late 2019, early 2020, and things started to really devolve, there was a lot of interest in bringing out that analysis again and seeing what had been discussed over the last 5 years.
Where are we in the gold and silver cycles?
I contend that gold and silver are still in a, particularly gold, in a more positive cycle since late 2015. And in late 2018, I did a couple of special reports explaining how we were now getting ready, particularly in gold and gold stocks, entering the more bullish phase of that, and I thought it would last into late 2020, early 2021. And I still contend that to be the case. But within that context, gold has had just some of the most consistent and reliable weekly and monthly cycles, and this particular combination was looking for a multi-month high in March or April of 2020, and gold decided to fulfill that twice, giving a spike high in March and then a spike a little bit above that in April. But it has just had, throughout the past decade, it has had a very consistent 12.5 to 13.5 month cycle, and what that really breaks down to is 55 to 59 weeks. And going back to the major peak in September of 2011, it set a secondary peak in October of 2012. And I guess I should also step back here and explain that the way I view cycles, and a tool that I developed back in the 1990s that I called cycle progression, I look for cycles to go through a progression where you'll see 4 consistent highs, and as long as that 4th high is below the 3rd high, and you've got a couple other factors, then that cycle is expected to invert. And so after the 4th one, you see the entire cycle being a downtrend, and then at the end of that cycle, a low is set, and then you start a sequence of 4 lows, and as long as the 4th low is above the 3rd low and a couple other factors are in place, you then see the cycle following that 4th low, you see an uptrend for the entire phase of that cycle, and it ends up now starting a series of 4 consecutive highs. I illustrate this with a sine wave and the different peaks and troughs along that sine wave, but I should explain that so that when I'm jumping from highs to lows, you'll see why this is very consistent with that. So after the October 2012 peak, you then went into this phase because that was the 3rd and 4th peaks, and the 2012 peak was lower than the 2011 peak. And then gold went into a 55 to 59 week decline, set a low in November of 2013, earlier in the month, and then in late November 2014, and then in early December 2015, and then a 4th low in late December 2016. Each of those lows was 55 to 59 weeks apart. And that December 2016 peak was then expected to trigger a 55 to 59 week uptrend, since that sine wave was now crossing over the 0 line. And sure enough, it created a 55 to 59 week uptrend into January 2018 when you saw a peak. A little over a year later, you saw another peak in late February 2019. And at the time, that was already saying, okay, watch March, April of 2020 for the next peak in this cycle. And I do think there's going to be one more coming into play in April or May of 2021. But there have been other cycles that have really honed that and kind of brought it down to more specific time frames. And so I think that gold is in that phase where we've seen a couple of very important peaks, and it's likely to consolidate, although consolidate very volatilely and swinging wildly below that April high for a few months. I'm even looking at late June as the time for a very important bottom. So been saying that I thought we would see a decent sell-off in gold in between there. But that's kind of the broader scope. I have more specific daily and weekly things to watch that I include in my weekly relay publication. But all in all, I think it's an evolving uptrend that is going to continue and stretch probably into 2021.
What's the cycle for the U.S. dollar look like?
The dollar has had a very intriguing cycle to me that has really governed it since at least the 1990s. I think I even documented it back before then. But it has been a very consistent, it's about a 3.25 year cycle. And in almost every case that has ranged between 38 and 41 months in duration. And the most recent time when a peak was expected was around March of 2020. And that was linked to the peak in late December 2016, early January 2017, 3.25 years prior. And so the dollar saw this big surge on the stock market sell-off in March, spiked well above its recent highs, although it didn't exceed those 2017 highs. And at the same time, it was fulfilling a very consistent 23 to 24 week cycle that had kind of gone through that same cycle progression that I talked about. There had been a pair of lows a couple years ago, and then you saw a sequence of 3 highs every 23 to 24 weeks, and the next one was expected in March, and so it aligned very closely with those broader monthly cycles. And there was a host of other, not just cycles, but timing indicators that, again, I used them to give me more specific expectations and to validate and corroborate, or else to kind of negate some of the more general cycle expectations. And they were all telling me to look for a very significant peak in March. And I think that's where we're at, coming off of that peak. And I think the dollar is starting to confirm that peak is going to hold for quite some time.
What do the cycles look like for the stock market, especially the second half of this year?
I have been saying that I thought this entire period in, in 2018 through 2022 would have a lot of similarities to the period that occurred exactly one 40-year cycle ago in 1978 to 1982. And so far, the period from 2018 to early 2020 has really fulfilled that expectation and just given me more confidence to continue to expect some similarities. And again, this is not, it's not suddenly pull out a chart of 1978 and through 1982 and overlay it and you've suddenly got your crystal ball. It's not like that. But it's looking for similar swings, similar cycles, and again, we've talked about this back in January and February in a couple of our discussions, but I was discussing the 40-year cycle and also a very consistent 2-year cycle that has been governing the stock indexes since about 2008, 2010. And both of them were, along with these 7, I called it a perfect storm of sell signals in early February. All of that together was telling me to look for a sharp sell-off from the middle of February, which is exactly when peaks were seen in 2018, which was 2 years prior, the 2-year cycle, and when they were seen in 1980, exactly 40 years earlier, and from there to look for a sharp sell-off into March 23rd to March 27th of 2020, which is exactly when the market bottomed in 1980. It's when the Dow set its lowest close in 2018 before rallying into September, October, and then seeing a sharper drop. And it was in line with a lot of these other indicators, but it was just kind of uncanny to me to see how precise and how much corroboration there was to this scenario for a big sell-off from mid-February through March 23rd to March 27th. We saw our crash in the markets, and the Dow and a lot of indexes set their exact low on March 23rd. And again, that just reinforces to me that this 40-year cycle, for whatever reason, is just providing a lot of parallels, a lot of guidance, and along with other indicators I have, I was looking for that low to be a major low in the stock market, and then to see some volatile back and forth trading for the second quarter and third quarter of this year. But if that 40-year cycle holds true, you go back to early 1980s, and the market, after spiking to a multi-year low in late March 1980, it eventually made its way back up to new multi-year highs in early 1981, and then saw an even bigger decline into third quarter of 1982. And it's interesting to me that a lot of corroborating cycles and indicators have been telling me to look for something fairly similar to that. And as long as those filtering and confirming technical indicators continue to reinforce that scenario, that's the one I'm expecting, where we see the market recovering and probably stretching that recovery into the first half of 2021, and then the other shoe drops. And so on a more near-term basis, I think that the markets are set for a couple weeks of correcting during the first part of June. I'm expecting the ideal scenario is, if a market is going to do that, is usually to see it peak within the first 3 to 4 trading days of the new month. So we're right in there now. June 3rd, June 4th would be the ideal time for a multi-week top, and then some selling into mid or even a little bit past mid-June. But as long as no real technical damage has been done at that point, I think it would be another chance to get back onto the long side of the market.
We'll have more with Eric Hadik right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're chatting with Eric Hadik. Eric, what kind of a cycle of economic disruption do you see?
Well, one of the things that was the most intriguing to me, and I recall you and I talking about this last year after I'd published some analysis on this, but it was a cycle that is very closely linked to the solar cycle, and by that I'm talking about the cycle of sunspots and solar storms. And this is not, not getting into very esoteric, astrological type of analysis where, one conjunction is governing one market and another opposition is doing something to another market. This is just a broader cycle that is certainly would have some evidence and some validity to it, because on an approximate 11.2 year basis, the sun goes through this explosive to non-explosive period, where at the trough you'll see very few sunspots, and then at the peak you could see just a massive outburst of them. And excuse me, when those flares are strong enough, they have the G and the M and the X class flares. When they're strong enough, and when the sun is turned towards the Earth at the point of those explosions, excuse me, it hurls these coronal mass ejections of geomagnetic or magnetic waves at electromagnetic waves, at Earth, and it impacts everything about Earth. So it's not that this is some very hard to fathom or imagine it having an influence. It has, and I did this analysis in February and March of 2019, over a year ago, and explained how it should come back into play in late 2019 through mid-2020. And what I called it was, I did two different tables. One was the 11-year cycle of global shaping events, and the other was the 11-year cycle of stock panics. And this is what I called them over a year ago, and kept focusing my readers' attention on late 2019, early 2020. And when you talk about the global shaping events, and now I was talking as much from a monetary but also socioeconomic perspective, you can go back to the Civil War in America, and even well before then. But I was looking at it from a American perspective, and the end of the Civil War, 1862-63, this cycle hit and led to first an overexpansion and then a collapse of the J. Cook and company, and it had to do with railway bonds, and then 11 years later you had the panic of 1873. 11 years after that, the depression of 1882 to 85, and it just kept flowing forward. The panic of 1907 was there. Then you had World War I and everything associated with that 11 years after that. 11 years after World War I, you had the stock crash and Great Depression entered in. 11 years later was the U.S. entry into World War II and everything associated with that. We had the culmination of the Korean War 11 years later, then everything that came with the Cuban Missile Crisis and the entry or escalation in the Vietnam War, where America was concerned. 11 years later was Watergate, Nixon's resignation, the stock crash. 11 years from there was the stock crash of and the 18-month interest rate rise of 86 to 87. 1997 to 1998 was the Asian and then the ruble crisis, both of which hit the stock markets pretty hard. And 11 years from there was 2008, 2009, which was, the Great Recession, financial and real estate meltdown. And all of that pointed to late 2019 through early 2020 to have a similar first wave of a financial implosion, and that's what we saw over the last 2 to 3 months. So that disruptive cycle, and I do, in these reports that I did last year, I also expound on a lot of related events, not just the financial, economic ones, but those always have an impact on socio events, and there's usually natural events occurring at the same time. So we're right in the throes of that, and you have to look at more specific things once you get past those broader cycles. But it'll be interesting to see, and I should say too that as we rolled into December of 2019, and I started talking about stock market cycles that were topping in January of 2020, well, at the same time, we got confirmation that the solar cycle had just shifted. And I know I've pointed this out before in some of our conversations, but the way that astronomers and scientists distinguish that is the polarity of those solar flares, because what the sun does is during one 11-year cycle, there's one polarity to those sunspots and solar flares. From our perspective, it would be like having something northern-oriented and then southern-oriented. And so during the ensuing 11-year cycle, that polarity shifts. And so it's very easy for them to identify when, and at the transition, you'll sometimes get some sunspots that have conflicting polarity, because you've got ones that are still linked to the old cycle and ones that are starting the new cycle. And the reason I mention that is that historically, a lot of times it's been that first couple years of the new solar cycle when you see this sudden surge in sunspots, and they've had impacts on everything from climate and growing seasons to back then it was telegraph wires and telephone and whatnot, but they could impact satellites and other things here on Earth. So we're into that phase of this solar cycle at the same time, so it will be interesting to see over the next 1 to 2 years if we get a few of those exacerbating solar events that just kind of pile on to the challenges that have already emerged.
What kind of cycle are we in when it comes to crude oil?
Crude has been in since the third quarter of 2018. That was really when I discussed a 5 and a 10-year cycle that were peaking then and pointing to a pretty bearish period. And often the midpoint of a cycle like that will see your trough. And so that still is a little ways out, but from a little bit narrower cycle basis, crude has had a fairly consistent, about an 18-month cycle, and that has been telling me to look for a bottom and things to turn more positive in the third quarter of this year. So I do think that crude is in a bottoming phase. I think that all of the products, energy markets, are showing signs of a very slow, subtle bottoming. And at the same time, there was and is a very consistent 2-year cycle and an overriding 4-year cycle in natural gas that was telling me to look for a bottom in the first quarter of 2020 and then an overall advance from there into the end of 2020, into November, December of 2020, and then a secondary advance or a follow-up advance coming in 2021. So I think that natural gas is also a market that's interesting to me, and it has really been validating those cycles the last couple of months as well, with an initial surge, and now I think that we're getting ready to see a second advance in that market. So all the energy markets, I think, are certainly showing signs of bottoming. They've got a few other indicators that they need to kick in to get me more bullish, but it definitely, on a 3 to 6 month basis, is something where we've either seen or seen very close to the lows, and that the general trend, I think, should angle upwards in the second half of the year.
Is real estate following any particular cycle?
You know, because of all the different nuances there and the different regions, in the past, I've tried doing real estate analysis and trying to get some clear expectation, but like I said, it's so area specific in many cases, and that I have trouble pinpointing something with that. But there are some corresponding cycles that I think could have a really interesting impact over the next couple years. And what I have been discussing is the idea of large metropolitan areas starting to see a gradual decentralization, and the events of the last 2 to 3 months have just so powerfully corroborated that potential. Doesn't mean that it's really happened, but there was already the move towards some decentralization of office work, with more people being able to work from home 1 day a week, 2 days a week, and so for a lot of these big businesses to be spending the money on the exorbitant real estate, commercial real estate in cities, the handwriting was on the wall. Then you get coronavirus, where the denser the population, the harder it is to avoid getting infected. But not only that, when you have the stay-at-home things go into effect, when you have a dense population, it's much more prone to shortages. With if normal shipping and restocking and whatnot of essential goods is taking longer and has more hoops for everyone to jump through, and so that's another exacerbating factor. Now you've got the civil unrest doing the same thing, particularly in your higher density population areas. And there's a final thing that I think could pile on that whole scenario, and it's something that it's another one of these longer term cycles that I first started discussing in 1999 and then revisited in 2009, and it's what I call the decade bubble effect. And the reason I termed it that there when I wrote this in the late 1990s was that I had seen a fairly consistent sequence of through each decade you would get a particular investment. It was almost always something financial oriented that would go through a type of bubble, a type of mania, and right at the turn of the end of the 9-year, beginning of the 0 year of the next century, you would get the peak in that particular investment, and then you'd get a bubble bursting in the first few years of the next decade. And I talked about that, going all the way back to even the 1920s and the peak at the very end of 1929. And then it was the first 2 years of the 30s that saw the stock market completely collapse into the bottom in 1932. but the overall bear market really stretched into the next decade. But you saw similar things, and then in the 60s, it was what I called an interest rate mania. Throughout the 60s, where Fed funds went from 1% up to 9%, then crashed to below 40% right after the start of the next decade. And funny enough, then in the 70s, you had a kind of a related thing with inflationary commodities and gold, where they had their mania throughout, that really accelerated in the final years of the 70s. Gold peaked in January of 1980, right at the turn of the decade, and crashed along with commodities, along with inflation, along with interest rates. And then you went into the 80s, and really the thing in vogue, we had our own stock market move starting, but the Japanese stock mania is really what ruled the 1980s. And sure enough, the Nikkei peaked at the very end of 1989, December of 1989. And after a complete decade-long euphoric rise, and then crashed in the ensuing years. And so as we were coming through the 90s, I was writing that at the time, you had a real mutual fund mania, and the dot-com bubble was really in its frothy stages. And I was talking about how to look for a peak and a bubble bursting in the early years of the 2000s. We saw that, and then as we came into 2009, I was reiterating this whole thing and discussed a couple of candidates that I said for that decade bubble effect. And all of that is a long, lengthy preface, but giving some context to what I think you could see, and is starting to play out a little bit. In 2008, 2009, I discussed a few candidates that I thought could be this decade bubble, but one of the ones that I discussed only had a small bursting in 2010, and then went on to really go into a mania throughout the 2010s, and that was what I termed as sports payroll mania. And the amount of money that was being paid for basically entertainers, and that's not a dig on sports. I enjoy watching some good sports games, but it was the amount of I broke it down to some of the pitchers at the time and what they were being paid per pitch, and just astronomical. And right after the 08-09 meltdown in the stock market, you did see there were certain sports teams that took a real hit, and they were I remember the Miami Heat having to take these big payroll cuts across from staff and administrative all the way down. You had the Mets and some other owners, I think, involved in that were also kind of in with Bernie Madoff and got burnt by that, and some other things. And so you saw this dip, but it wasn't the bursting that I thought was possible then. And actually, a couple other markets did kind of peak and burst then. But I started looking ahead towards the end of this current decade as the next candidate for that sports payroll mania peak. And you're certainly seeing some events that could now play out over the next couple years and really start to strain and force a lot of renegotiation of the sports contracts, because filling the stadiums and the coliseums and spectrums and whatnot, arenas, is where a nice chunk of that money comes from. There's also obviously advertising and other contracts, but And the thing is, my kind of link here to the previous conversation is even that will also factor into urban areas, commercial real estate, because, where are all these teams based? Where are their stadiums based? It's in the big cities. And so now all of a sudden you're going to have games with no fans. Well, what's going to happen to all of the hospitality industry within those cities and all the hotels and related things? And so you've just got this, that's now the fifth or sixth major event that's going to at least take a year or two to play out. And by that point, if the snowball's already starting to head down the mountain, it's kind of hard to jump in front of it and say, okay, wait a minute, we're good now. Things are worked out. And so I think that commercial real estate in urban areas, or in big cities, I should say, is certainly a risky proposition over the coming years.
Eric, how can people find out more about Inside Track Trading?
The best way is going to our website at InsideTrackTrading.com, and that is with the extra I in the middle of inside, so INSIIDE, tracktrading.com. They can also visit our 40-year cycle, that's the number 40yearcycle.com website for related analysis and publications that have been archived on both of those sites, and also request samples and trials through those websites for anyone that hasn't received a trial in recent months. And then we can really provide more information and a better understanding of what we do offer.
Eric, thank you so much for being on This Week in Money.
Thanks for having me back, Jim.
My guest has been Eric Hadik, CEO and President of InsideTrackTrading.com. He was speaking to us from the Chicago area. Coming up, listener questions and interesting headlines with Bob Hoye next on This Week in Money.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABN.AF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forrest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim.
Bob, the way we usually do our show when we're on HowStreet.com is we do some listener questions, and then you take a look at some of the key headlines of the day. So we'll follow the same format here. Our first listener question, are we heading into stagflation?
Yep, actually it's an appropriate question. And stagflation, for our younger listeners, occurred in the 1970s when the central bankers were boosting the money supply, trying to get more growth out of the economy. And then what wasn't being used by the economy went into speculating in tangible assets, which was commodities and houses, and you had what everybody understood as inflation going on then. And no, to actually, the 1970s are not going to come back. What we are looking at is the post-bubble contraction, where I think deflation will overwhelm the Fed's reckless expansion of credit. It's a guess. It's the way the economy has worked in the past. You have a great financial bubble, and then you have a contraction. So we'll stay with that theme.
Two more questions here. We hear that many millennials are using their unemployment benefits and government checks to play the stock market using call options in the tech sector. Is this a contrarian indicator, or a longer-term bullish change in sentiment from this next generation of investors?
Oh, no, I don't know. That's rumor, whether it's happening or not. I think that's quite speculative. I doubt that there were any, shall we say, inexperienced investors buying at the lows. So, interesting question, though.
Also, a question for me, Bob. Are we seeing people who used to bet a lot on sports now placing bets on the stock market?
Oh, I don't know, Jim. I don't know how you can analyze that, but hey, it really is a good idea to follow up with.
Also, the agriculture sector seems to be really beaten down. Is this a good time to buy agricultural commodities or equity ETFs? Or should we wait until after the next down leg in equities, assuming one happens?
Yeah. No, it's, our technical analysis on the agricultural sector, GKX on the one I look at, had been low for years, and but it got itself into a technical position where it looked like it would rally. And we had a chart on that a couple of weeks ago, and indeed, since then, it's made a nice advance. Nothing spectacular yet, but I remember on Thursday looking at it, and the 20-week moving average. So, the action is constructive, and if it gets above the 20-week, it could we could describe it as a little more constructive. So, we'll wait and see. But I certainly wouldn't hold any positions after August.
And our final listener question of the show, does Bob have a book he can recommend about the stock market during the Roosevelt era in the 1930s?
Oh, yeah, that's a good question. There's Money of the Mind by James Grant, the financial writer, who is an outstanding writer. Then there's one on any number of, it's called A History of America's Financial Disasters, but Robert Sobel, S-O-B-E-L, and it's called Panic on Wall Street. And I'm looking at these and passing them on. And here's another very good thorough one about the social history of the Wall Street crash. The Day the Bubble Burst by Thomas and Morgan Witz. That one's very good detail. And then others that I've got in my bookshelf is the one called Reminiscences of a Stock Operator. And this was attributed to Jesse Livermore, who in the teens and 1920s was an outstanding trader. And then a more scholarly one, Once in Golconda, by John Brooks, and that again is about the 1920s. Well, I'll add on too, also an economic historian. His last name is Kindleberger. He's published a number of books on financial history, and is always worth reading. And thanks for the question.
Well, take a look at some interesting headlines with Bob when This Week in Money returns.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Bob Hoye. Bob, is America heading to a post-apocalyptic collapse in currency?
Yeah, that one. Again, it's the learning that occurred in the 1970s where central bank recklessness went into commodities and hard assets, tangible assets, that sort of stuff, and to a lesser degree in stocks, which was like the 19-teens. And that global mania in commodities completed in 1980, crashed very hard, and then set up the world of financial asset speculation. So again, what we have here now is those pundits and advisors who learned the lessons of the 1970s, are applying it to this period in time, which isn't applicable, I think. Again, as we said earlier, the pattern is huge speculation in commodities. The last peak was in 2011. And then about a decade later, a peak in stock and bond speculation, which perhaps we're getting, and then a contraction. So I'll stay with that. And the Fed, all central bankers, they learned the 1970s as well, and they know very little about, on the serious side, about financial contractions.
Another headline that caught your eye, meet the world's dumbest mortgage broker. Well, who is the world's dumbest mortgage broker, Bob?
In Canada, it's the government with the Canadian Housing and Mortgage, whatever, corporation. And the article was that they've been doing some pretty stupid things in mortgage market. And why do you need a government running a mortgage portfolio? I really don't know. It's absolutely absurd. Because when you're in a boom, the private side of the market can provide any and even more credit that's needed. And you really don't need another agency under the hands of government providing credit. Not at all.
And I also saw a headline, too, saying that CMHC is going to make it harder to get a mortgage. Well, we're going through an economic downturn. People are losing jobs. What could make it harder to buy a home if you really need or want one than having another government agency jump in and say, guess what? We're going to pose another challenge to you.
Mm-hmm. No. And then, of course, we all know the history of the government abilities to make the right call on anything. It rarely happens, the right call. So there really is no need for government intervention in anything. You have the central banks intervening on manipulating currency values and also manipulating interest rates, and all founded upon some arbitrary idea of a committee about how strong the economy should be. It's been a long and reckless experiment, and I think a serious contraction. The public's going to take a look at a lot of these games that central bankers have been playing and say, no more, buddy. And the only way you can constrain a central bank, of course, is by a gold standard. They can't print another dollar unless they got a little more gold. So, and this is the whole point. This gets, Jim, actually a very intriguing setup here, where the interventionists defend the central bank activity as saying that it's needed to manage the economy. And also, you go back to the formation of the Fed, when the idea was, with the Fed as lender of last resort, it would prevent the credit hits that precede recessions. And there's the only answer to that one has been 18 recessions. So then you take a look, just scholarly look, on a currency in a gold standard. And if you have the Fed now has been corrupted to where it is funding another experiment in unlimited government. The story about managing the economy is just window dressing. But then if you're on a gold standard, it constrains them. So in effect, the gold standard is there to manage the ambition of central bankers and their governments. You have no idea over how well a gold standard works with any currency, and particularly for the senior currency. And I think at some time we could go back to a gold standard. The public will demand honest money and honest government, and that's one of the ways to get it.
Bob, thank you so much for being on This Week in Money.
Jim, good to be with you, and our listeners have a good weekend.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Eric Hadik, and Bob Hoye. And thank you for listening. If you have any questions for the show or for our guests, you can send them to info@howestreet.com. Now stand by for company showcase updates from American Manganese President Larry Reaugh, Cypress Development's Don Mosher, and Aben Resources CEO Jim Pettit. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Jim, it's always great to be on the show.
Larry, some positive news for you guys. The Economic Standard publishing an article on the criticality of manganese.
Yes, and that was an article that was written in here, and this would be our fourth article with the Economic Standard. The first three, we got a total of 157,000 reviews, and so that just goes to show you that we built up a good readership on that, and this is our fourth one. I don't have any idea how well that's gone over yet. It was published on Tuesday, and but it talks about manganese, and I wanted to mention that because we're talking about manganese because a lot of people are talking about manganese. We're getting a lot of interest in manganese, and the criticality is simple. It's you can't make steel without it, and without steel, the world stops. So that really gives you the one line on just how critical it is. And the U.S. has no domestic source or supply. We spend a lot of money on R&D, and we developed a patent back in 2000, which was granted in 2012, and we got the keys to that basic area, but to qualify, the price of manganese is nowhere near where it should be. It's down about 50% from where it was when we did our Prefeasibility study. So, I've been following it, but the only reason that we decided to do an article on it was so that we could remind our readership and investors that this is where everything developed for the recycling of lithium-ion batteries. So it's just an informative article, and I thought it was pretty telling. I mean, the fact is that the U.S. has manganese deposits, all low grade, and they have to be of a specific chemistry in order to work with the process that we developed after the U.S. Bureau of Mines spent 60 years on that process and tens of millions of dollars. And so that's just our roots, and it doesn't mean we're going straight into the manganese business, but you never know. We have interest from various parties, including governments, and so it's a topic, and it should be talked about. But it's an exciting day in the market for the Dow. It's up about close to 1,000 points the last I looked. And the Dow is, that was based on the jobs figures. It basically says that employment rises employment rising by 2.5% to 3%. Now, that's significant in these markets. If you look at the markets and see how they're going, I follow the Dow
rather than any other market out there, because basically I'm astounded. I did predict a V-shaped recovery, and that is happening as we speak. And I predicted that right after it dropped, and that was a couple of months ago. So I see that's fulfilling, and you have to say to yourself, well, who's buying these stocks? Everybody's talking about losses, layoffs, bankruptcies, everything else, and yet the market keeps going up. Well, naturally, I think a lot of the market the market thrust is from the U.S. government, and they make funds available to various funds around to protect another plunge from another plunge. And I think that there's a lot of millennials that are piling into the market in a big way. What does that say to me? Well, that says to me that there's definitely going to be a shift in wealth, and some of these millennials will become the new multi-millionaires in the near future, and that's what I see as a thrust. That's just my opinion, but millennials could be the basic reason behind the market going up so rapidly, and because it's a astounding recovery, and we hope that we're going to be able to join that recovery here shortly. And speaking to that, we announced 2-3 weeks ago that we were optimizing our plant and putting more throughput through and everything else, and that includes a lot of R&D, which I hope now is all completed. And we've certainly got nothing that sets us back. And, I'm looking forward to some pleasant results. And those results incorporate the fact that maybe we don't have to spend so much, or maybe we can build larger on the plant, because we're hoping to save on CapEx and OpEx. And so it's a great place to be right now, Jim. Now, the two big major factors for us is or three, I should say, is the the op-ed that we just completed, the what's happening in the U.S. Dow, and the what's happening with our optimization. But it's I'm excited, and I see a big shift coming in the market. We're getting all kinds of calls, and people would be astounded at the people we talk to. But, that includes looking at our process, includes, beginning to talk about financing, all of these things that we need. And, it's going to be a tremendous year end for us.
Larry, for people new to American Manganese, what's the company all about?
American Manganese is a critical metal company, and it developed a process for low grades of manganese back in starting in 2007, 2008. We patented that process in 2012. It's now patented in 4 countries. We took that as a cornerstone for recycling lithium-ion batteries, the cathode material, and we had great success in 2016 on a proof of concept, and since then we've completed a pilot plant, and now we're optimizing that pilot plant, and we get close to 100% recoveries and purities in the material that we produce. So it's been a great thing to work on, starting with the manganese and now into the cathode materials. So we're traded on the Toronto Venture Exchange under the symbol AMY.V. We're traded on the U.S. under symbol AYMZF. We're traded in Frankfurt under the symbol 2AM. We have a very informative website out there called AmericanManganeseInc.com. We have people can reach us by emailing. My email is LREAUGH@AMYMN.com. or you can phone 778-574-4444.
Larry, thank you so much for the update.
You're welcome.
My guest has been Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on June 5th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Don Mosher, corporate consultant for Cypress Development. Welcome back to the show, Don.
Pleasure to be here, Jim.
Don, some important news for Cypress Development. Can you tell us about it?
Yeah, after about a year and a half, we finally published our Prefeasibility study on the Clayton Valley Lithium project in Nevada. So it's a big step forward for the company. Because there are no claystone commercially producing mines anywhere in the world, credibility is a huge issue when you start looking at something as new as this.
Just how big is this proposed development?
We've only looked at a fraction of the project. The project will process 15,000 tons per day of claystone ore to produce 27,400 tons of lithium carbonate equivalent once it goes through the leaching process. So in a year, it'll be 27,400 tons over a 40-year mine life. And all we've looked at is about 300 million tons of claystone in a project that, I'm going to take a guess, but I can promise you it's going to be over 1 billion tons in size. It just didn't make any sense to do any more drilling when you've already got 40 years to focus on.
Nevada's a very pro-economic resource development, geopolitical space. Elsewhere around the world, I understand that some places where they withdraw lithium, the political background is kind of chancy and it may be risky for investors. How does it look like if you're investing in something in a project in Nevada?
Well, to start with, Nevada is the third largest producer of gold in the world. It represents a huge piece of Nevada's GDP. And because mining has been going on in Nevada for probably close to 200 years, they have a very solid understanding and appreciation for the importance of it. So it really is very friendly when it comes to mining jurisdiction.
Don, can you tell us a bit about Cypress Development?
So about 3.5 years ago, we acquired ground in Clayton Valley, Nevada. We're, a stone throw from the only lithium producer in the United States, which is Abermarle's Silver Peaks brine mine, and it's relatively small. I think they produce about 3,500 tons of lithium carbonate equivalent annually. So if you compare that to what we're looking at 27,400, it gives you a feel for the size of it. They produce the lithium by pumping brines out of the aquifer under the valley into evaporation ponds, and they allow wind and sun to evaporate the brines down to a point where they pull it out and extract the lithium out of it. Their concentrations of lithium, I think, have dropped to maybe 110 ppm. And they were the very first brine mine in the world. They've been in production for over 50 years. The large operations that run are exactly the same as this. They're up in the Atacama Desert in Chile and in Argentina. And because these things are pumping brine out of aquifers at the same time, they're depleting the water supply. So the Atacama's the driest desert in the world. And there are local populations that live there and depend on it for agriculture and for drinking water and just daily use. And they've now got to a point where the courts have basically said the local users have priority over the mine. So SQM and Abermarle have been basically told that they can't expand their operations further.
then on top of that, you've got the civil unrest, and this whole COVID-19 situation is not helping the problem out at all. In the meantime, we're in the United States of America, which is one of the top 5 importers of lithium in the world, along with China, Japan, and Korea, and they virtually have no supply of their own. So what we're offering is a domestic, dependable supply of lithium that can last for decades. To me, it's one of those metals that's absolutely necessary if you're going to move into a green energy type of environment where, Tesla, for example, is located in Nevada. They're building lithium batteries with Panasonic. They need lithium. I believe that GM is building a battery plant in Ohio. They're going to be depending on a supply of lithium to build those batteries there. In the U.S. right now, there are 2 other companies that are doing something similar to us. One is Ioneer up at Rhyolite Ridge. Their project's a little different because they have boron as well, and really it's primarily a boron project with a lithium offtake. They'll be taking the clay stones and leaching the clay stones to first pull out the boron, and then they'll be taking the leftover brines and producing the lithium out of it. Then to the north of us, we've got Lithium Americas, and they have Thacker Pass. And I would say that is very comparable to us. It's a clay stone. They're at a prefeasibility stage like we are right now, and they've been spending a lot of money on it. I was just looking at their quarterly financials this morning, and they attributed a $14 million loss for the 3 months to the development costs of Thacker Pass. If you take a look at what we've done at Cypress, because it's such a bare bones operation, and I only mean that in the most complimentary terms. Our CEO, Bill Willoughby, has basically developed this thing with the help of consultants, not with full-time employees. And as a result of that, we've taken this project from a preliminary economic stage to a full pre-feasibility stage on less than $2 million. I haven't gone in and taken a look to see what Lithium Americas has spent on Thacker Pass, but, they've probably spent 50 times that much. And Lithium Americas does have some other projects in Argentina. They've got a brine project there that they own 49% of. Ganfeng owns 51% of it now. And, they're trading at $7 and we're trading at 21 cents Canadian. So we really need to get some eyes on the project. I think at some point in time, somebody's going to say this thing's too good not to own. And that's where I think our project ultimately is going to go. We're not going to take this thing all the way through to production.
Don, can you touch on the economics of the project and where you go from here?
Yeah, the economics are quite reasonable for a project this size. The capital cost estimate on this these are all U.S. dollars, by the way. We're looking at about a $493 million pre-production and operating cost. That a big piece of that would be a sulfur generation plant where we're producing sulfuric acid. Our estimated average cost per lithium carbonate equivalent comes in at about $3,329 U.S. Right now, the spot market on lithium hydroxide is running at $9,750. Lithium carbonate runs at about $7,500 a ton, and we would be producing both carbonate and hydroxide. So we've used a $9,500 number for our sales price. We believe we'll be predominantly hydroxide, but we've got to get into a pilot plant operation to really see what the combined number is going to look like. So the next step for the company is going to be moving into building a pilot plant and operating a pilot plant for a number of months to really figure out how to actually produce the product. We're looking at 6 months and a cost of about $6.75 million U.S. to build a facility. And I think we'll probably be looking for partners to come in on this people that will have an interest in ultimately owning the project, and as opposed to running out and diluting the stock and raising money via private placements or whatever, I think we might be out there looking for partners on this. There's obviously going to be some very viable candidates still in this project. Anybody in the U.S. that's importing lithium would be a potential viable partner, and anybody refining lithium would be a potential partner on it. The Chinese have really cornered the market, so I think U.S. firms need to take a serious look at having their own independent domestic source of lithium.
Don, what would you estimate the total value of this project to be?
Well, none of these are my estimates. I'll just read it straight out of the PFS. An after net present value with an 8% discount values this project at $1.052 billion with an after-tax internal rate of return of 25.8%, and that's based on $9,500 a ton lithium. The disparity is right now, Cypress has a market cap of under $20 million Canadian. So here's a company that owns a project with a deemed net present value of over $1 billion US, trading at under $20 million Canadian.
Where can people get more information about Cypress development, and where are you traded?
We are traded on the Toronto Venture Exchange under the symbol CYP. We trade on the OTC bulletin board, the QB board, excuse me. The symbol there is CYDVF. And then there's a Frankfurt listing, which is C1Z1. All our information is available at CypressDevelopmentCorp.com. You can find all the filings on CEDAR. So if you want to read through a very long PFS, you can actually go there and it's published. And all our information's on the website, obviously.
Don, thank you so much for the update.
My pleasure. Thanks very much.
I've been speaking with Don Mosher, corporate consultant for Cypress Development. I'm Jim Goddard. Our conversation took place on June 4th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Jim Pettit, CEO and President of Aben Resources. Welcome back to the show, Jim.
Thank you very much, Jim. Been a while.
Yes, it has, and but Aben hasn't just been sitting around during the coronavirus crisis. You guys have been busy?
Yeah, we're busy behind the scenes. And you're right, well, we haven't actually been sitting around. Been really busy through this whole 3-month stretch, the last 3-month stretch. I'm in the office every day. And we're plugging away. We've got a lot of data that we put together, and we've got some pretty good plans for this year. I don't think you'll see 10,000 meters of drilling, but you're going to see, we're going to go up there and we're going to do a lot of field work, and that will culminate in a drill program come September. And it's all based on new concepts, new theories, basically. And if you want to get into that, I can start of giving some information on what it is we see and what we've learned over this past year.
Yeah, what's really caught your eye?
Well, last year we drilled from the southern extent of the north boundary zone, the high-grade zone, and we went south, and we were testing a lot of these geophysical anomalies that we got from the mag survey that we did a year ago, actually, May. And, you take all that information as we worked our way through the south boundary zone and south of the south boundary zone into what's called now the benchlands. And, we had some pretty good success drilling the holes in the benchland area, and they're strongly mineralized. And if we line up the benchland 4 holes we did right behind the core shacks, they line up with it. Well, you'll see it on the new website that we're doing. The south boundary drilling from the year prior, they line up perfectly. They look like they're getting the mineralization from the same source as polymetallic. It's lower grade than what we got in the north boundary zone, but it's broad intersections of lower grade, like from the 1 gram to 2 grams, half gram to 2 gram, that sort of thing. And then some spikes in there that can hit up to 14. Something very interesting is feeding it. Then we basically hit upon a fault. It's called the Benchland Fault now, and it's basically looks like it could be an offshoot or a continuation of the creek, what we call the Creek Fault, the Nelson Creek Fault, which the north boundary is just on the right side of. The drilling on the benchlands and the south boundary zone are on the east side, not the right side, the east side of the what we're calling the Benchland Fault. There is a possibility that they're the same fault, and that's what's been one of the controls that we've been looking for. So what we're going to do this year is test the zone, that immediate zone between the north boundary Nelson Creek Fault and the south boundary Benchland Fault. And we're going to do a lot of field work there. There's some anomalies we didn't test because we didn't have any groundwork to lead us in those directions. The geophysics that area was covered in scree, and so there was no outcrop and there was no means of testing that for ground truthing purposes, and then followed up with drilling. But we're going to do that this year because that could be, because as you get back up into the north boundary zone, the alteration starts kicking up with potassic alteration, and more of that, which indicates proximity to a feeder zone, a heat source. And so it's looking pretty positive. When I get the new website up and running, you'll be able to follow the new PowerPoint that's going to be on it, and it's it shows you what's happening and the way we're looking at it now, and it's the first time we've actually drilled there with an indication of the structure and the controls. This is going to be a pretty exciting year, but it's definitely not. We're not going in to drill another 10,000 meters right away. This is going to be, okay, let's check this out, let's test this theory, and start at the south end and work our way back up to the north along this benchland fault.
For people new to Aben Resources, what are you all about?
We are gold exploration, a gold exploration company. We've been drilling up in the Golden Triangle of northwest quadrant of British Columbia for the last 3 years. We've drilled 20,000 meters. We've got a pretty good idea of what we're looking at, and what we've got this year, we're pretty excited about what we're going to do.
Where can people get more information about Aben, and where are you traded?
We're traded on the TSX Venture and the OTCQB, and in Frankfurt, the Bourse ABN.V. You can get all the information you need on the website, abenresources.com. And there should be a new website up and running in about a week.
Jim, thank you so much for the update.
Thank you very much, Jim.
I've been speaking with Jim Pettit, CEO and President of Aben Resources. I'm Jim Goddard. Our conversation took place on June 5th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.